Here's something that kept me up last night. Imagine, two people both made $100,000 last year. One person worked 2,080 hours for it. That's a standard full-time job, 50 weeks a year. The other person did absolutely nothing. They just owned some stuff that went up in value. Guess which one paid more in taxes? Yeah, the one who actually worked. And not just a little more, we're talking thousands of dollars more. And that's not even the craziest part. The craziest part is that this isn't a loophole. This isn't some sketchy offshore scheme. This is literally how the tax code is designed to work. And once you see the actual math behind it, you can't unsee it. There's a fundamental split in how the tax system treats money, and it has nothing to do with tax brackets or deductions. It's about one simple question. Did you trade your time for that money, or did your money make that money? And the difference in how those two things are taxed is absolutely insane. I'm an accountant, and I spend an embarrassing amount of time looking at tax returns for both regular people and wealthy clients. And here I break down the money concepts that actually matter for people trying to build wealth without the BS. If you've ever felt like the system is rigged against people who work for a living, and you want to understand exactly how it works so you can start playing a different game, hit that subscribe button. And if this helps you see money differently, smash that like button. Now, before we dive into the actual math, let me paint you a picture of what we're actually dealing with. You're at your desk job. It's 2 p.m. on a Wednesday, and you're grinding through emails, sitting in pointless meetings, dealing with that one coworker who thinks reply all is always the right choice. Every 2 weeks, you get a paycheck, and before you even see that money, the government has already taken their cut. Federal income tax, state income tax, Social Security, Medicare, the whole thing. You don't get a choice. You don't get to decide when to pay it. You don't even get to touch that money before the IRS takes it. Meanwhile, someone who owns a bunch of stock that went up in value, they don't pay anything. Not yet. Maybe not for years. Maybe not ever if they're smart about it. They get to decide when, or if, they want that gain to become taxable. And when they finally do pay, it's at a lower rate than you pay on the money you earned by actually working. We're about to get into exactly why this happens, and I'm going to show you the specific numbers that make this so ridiculous. Here's what actually happens when you work for money versus when money works for you. Let's say you make $100,000 as a software engineer. Before you see a dime of that, roughly $7,650 goes to Social Security and Medicare. That's just gone. It's not even part of the should I itemize or take the standard deduction conversation. Then federal income tax takes another chunk. Let's call it $18,000 if you're single with a standard deduction. We're already at $25,650 gone, and we haven't even talked about state taxes yet. In a state like California, add another $5,000 to $6,000. You're looking at $30,000 to $32,000 in total taxes. That's a 30 to 32% effective rate on money you earned by trading your time. But here's where it gets really interesting. That same $100,000, if it came from investments you held for more than a year, is taxed completely differently. Long-term capital gains rate for most people is 15%, just 15%. No Social Security tax, no Medicare tax, no state payroll tax in most states. And here's the kicker, you only pay that 15% when you choose to sell. If you never sell, you never pay. You can borrow against those assets, live off the borrowed money, and the IRS doesn't touch you. Let me show you exactly how this works with real numbers, because this is where the weird math really reveals itself. Imagine two people, both ended the year $100,000 richer than they started. Person A worked as a project manager. Person B bought some index funds 3 years ago and they went up. Person A pays $32,000 in taxes. Person B, if they even decide to sell that year, pays $15,000. That's a $17,000 difference. Person A has to work from January 1st until the end of March just to pay for the privilege of having worked the entire year. Person B keeps an extra $17,000 in their pocket for doing literally nothing except owning assets that appreciated. And this is something most people completely miss. That $17,000 difference compounds. Person B can reinvest that money. In 10 years, if it grows at 8% annually, that single $17,000 difference becomes $36,700. 1 year's tax difference becomes a down payment on a house. But here's the part that'll blow your mind. The truly wealthy don't even play this game. They play a completely different one. They don't wait for their stocks to go up and then sell them. They borrow against them. It's called buy, borrow, die, and it's how you can be a billionaire on paper and pay almost nothing in taxes year after year. You buy assets, you never sell them, which means no capital gains tax ever. Instead, you borrow money using those assets as collateral. Banks love lending to rich people because they know the assets are there. And here's the beautiful part from a tax perspective. Borrowed money isn't income. The IRS doesn't tax loans. So you live off borrowed money at 3% interest while your assets grow at 8%. You're making 5% annually on the spread, and you're paying 0 income tax. Then when you die, your heirs inherit those assets at the current market value, which is called a step-up in basis, which means all those gains that happened during your lifetime just vanish for tax purposes. Nobody ever pays tax on them. The wealth passes down, and the tax obligation just evaporates. I've seen this play out across dozens of tax returns. A client who owns a small business, lives in a nice house, drives a decent car, takes normal vacations, paying $45,000 a year in taxes on $180,000 of income. Meanwhile, someone with a $20 million investment portfolio, living in a bigger house, better car, fancier vacations, paying $30,000 that year because they only realized $200,000 in income, even though their net worth grew by $1.6 million. The tax system doesn't care how much wealthier you got. It cares how much income you reported. Now, you might be thinking, okay, but most people aren't billionaires playing the buy, borrow, die game. This doesn't apply to me. But here's the thing. Understanding this shift is how you start moving from one category to the other. Every dollar you can shift from earned income to investment returns is a dollar that gets taxed less heavily. This is why the wealthy are obsessed with building assets that appreciate rather than just earning more salary. There's this magical number where this starts to really matter. When you have around $500,000 invested, you can reasonably generate $40,000 a year in long-term capital gains if you need to. That $40,000, if it's your only income, is taxed at 0%. 0% federal tax on $40,000 of income. A couple making $40,000 from jobs pays around $4,500 in federal taxes, plus another $3,000 in payroll taxes. That's $7,500 they pay that the investor couple doesn't. Same lifestyle, completely different tax bill. And this is where most people mess this up, and I see it constantly. They finally start building some wealth. They get a portfolio up to $100,000 or $200,000. Then they get excited about their investments doing well, and they start trading frequently. Or they panic during a market drop and sell, or they cash out to buy something. Every time you sell an investment that's gone up, you trigger a taxable event. You're choosing to pay taxes. The wealthy don't do that unless they absolutely have to. I struggled with this mindset shift for years. I'd see my portfolio up 20% and I'd think, I should lock in these gains. And I'd sell, pay the taxes, and feel smart. But I was literally volunteering to give the government money that the tax code was letting me defer indefinitely. The smartest move in most cases is to just hold. Let it grow. Borrow against it if you need cash. Never trigger the realization event unless you have to. Here's what's really happening under the surface. The tax code is built around this idea that work should be taxed heavily and immediately, while capital should be taxed lightly and only when deployed. The logic goes, if we tax investment returns too heavily, people won't invest, businesses won't get capital, the economy stalls. If we tax work too lightly, the government doesn't have enough revenue. So workers become the tax base. It's not a conspiracy. It's just policy choices made over decades that created a system where time for money gets hammered and money for money gets a gentle pat. And there are even more layers to this that make it worse for regular workers. Sales tax, property tax on your primary home, gas tax. These are all taxes that hit you as a percentage of spending. And if you're spending most of your income because you don't make that much, these taxes become a huge burden. Someone making $50,000 who spends $45,000 of it pays sales tax on 90% of their income. Someone making $5 million who spends $300,000 pays sales tax on 6% of their income. The system is regressive the more you zoom out. I've spent way too many nights going down the rabbit hole of tax policy research, and here's what it comes down to. In 2021, the wealthiest 400 American families paid an average effective tax rate of 8.2%, not the marginal rate in the highest bracket, their actual take-home rate after everything. The median American family pays around 14% effective federal tax rate, plus another 7.65% in payroll taxes. A household making $75,000 a year is paying a higher percentage of their income to the federal government than people with 9-figure net worths. But here's where it gets really interesting. This isn't just about the ultra wealthy. This same pattern starts to show up way earlier than you'd think. As soon as you have even $50,000 invested in index funds that you're not touching, you're benefiting from this system. Those gains aren't taxed until you sell. You can watch your account grow by $4,000 or $8,000 a year and not pay a cent in taxes on it. Meanwhile, if your salary increases by $4,000, you're paying $1,200 to $1,400 in taxes on that raise immediately. This is why every financial advisor tells you to max out your 401k and IRA. It's not just about saving for retirement. It's about converting current earned income into future investment returns. You put $20,000 into a 401k. You avoid paying $5,000 in taxes today. That money grows for 30 years. When you take it out in retirement, you might pay $3,000 in taxes on it. But that $2,000 difference had 3 decades to compound. You just won the time value of money game. The shift that happens when you really internalize this is pretty profound. You stop thinking of your salary as your financial scorecard. You start thinking of it as your investment building engine. Your job isn't to make you rich through the paycheck. It's to generate enough cash flow to buy assets that will make you rich through appreciation. And those assets get taxed gently while your labor gets taxed heavily. So the goal is to shift as much of your lifetime income as possible from the labor bucket into the asset bucket. This changes how you think about work too. That raise you're negotiating, the step up from $80,000 to $95,000, you're not actually getting $15,000. You're getting $10,000 after taxes. But if you use that $10,000 to max out your 401k instead of upgrading your lifestyle, you've now got $10,000 becoming $80,000 over 30 years, taxed at capital gains rates instead of income rates when you withdraw it. You just turned a $15,000 raise into something worth way more than $15,000 by changing which tax bucket it lives in. And here's what most people completely miss. This is exactly what wealthy people figured out generations ago. They're not smarter than you. They just know that the game is about asset accumulation, not income accumulation. Income gets destroyed by taxes. Assets get protected by the tax code. So they keep their reportable income as low as legally possible and push everything into asset appreciation. There's this moment in every person's financial journey when the math flips, when your investment returns start generating more annual wealth than your salary does. For some people, that happens at $500,000 invested. For others, it's $1 million or $2 million. But when it happens, you realize you've switched tax categories. You're no longer in the trade time for heavily taxed money game. You're in the own things that grow and stay quiet about it game. And your effective tax rate drops by 10 or 15 percentage points just because you cross that threshold. But here's where most people mess this up after they've started building wealth. They see the system for what it is, and they get bitter. They complain about unfairness, which, yeah, fair. Or they try to copy the most aggressive strategies they hear about rich people using without understanding the nuances, and they end up triggering an audit or worse. The move isn't to get angry or get risky. The move is to just steadily shift your income from earned to unearned over time. Every dollar you save and invest is a dollar that escapes the high tax bucket and enters the low tax bucket. That's it. That's the whole strategy. Live on less than you make. Invest the difference. Let it grow without touching it. The tax code rewards patient capital and punishes active labor. So become patient capital. Slowly, steadily, year after year. The tax system isn't going to change anytime soon. The people who benefit from it are the same people who fund political campaigns and hire armies of lobbyists. So you have two choices. You can spend your life mad about it, or you can spend your life understanding it well enough to position yourself on the right side of it. Not through anything shady, just through the basic math of converting paychecks into assets and letting those assets grow untaxed until you're ready. Start building that foundation today, because your future self is counting on the decision you make right now. The weird math doesn't get less weird, but once you understand it, you can finally stop playing the game where you lose 30% before you even start. Trade your time, save the money, buy the assets, and let the tax code work for you instead of against you for once.